Hello and welcome to the special edition of Mutual Fund Corner YouTube edition. And today on the show, we have our guest, Kaustubh Belapurkar, who is the Director of Fund Research, Morningstar Investment Private Limited. Kaustubh, always a pleasure speaking with you. And, today we are not going to get very specific in terms of what asset class, what scheme, what funds should be chosen, but just generally trying to understand the basics when one actually starts mutual fund investing. And it's a much debated question as well. We've spoken about it in the past. What is better? Is it going via SIP or lump sum investment? Does it change if a person has a different goal in terms of the time period that they want to invest in as well?
Sure. Hi, Sonal, and thanks for having me on the show. And I think it's good that we're going back to basics, because I think investors need to really think about how they want to achieve their goals and go about their investing journey. So before I kind of get to addressing your question, let me we always talk about this timing the market or time in the market, what's more important. Let me share some highlights from a study that we do regularly to see, and kind of really talk about why spending time in the market is more important than time in the market, right? So what we did was, through the studies, looked at the broader equity index return. So it could be your Sensex or your Nifty, and we broke it down into monthly time series over the last 10 years, so about 120 months. Right, and we just put it in and compared that versus cash, right? So we just looked at the relative outperformance or underperformance of equity versus cash, and in this case, we use liquid funds as a proxy for cash, right? What we did was putting the best months of performance at the top and then went down in a descending order. What the study showed us that the best 11 months in the market accounted for the entire outperformance over a 10-year period, right? So 11 months, that's even less than 10% of the observations, account for the entire outperformance of the market versus cash, which means you as an investor, if you were not invested in the market in those particular 11 months, you would have actually underperformed even cash, right? And we all know that over 10 years, actually equities delivered significantly higher returns than cash, right? So I think that's a very compelling sort of data point, which tells you that you need to spend time in the market to make the most of the equity markets rather than trying to time it, right? Now, how do you do this as an investor, right? And like you said, what's better? Is it SIP or lump sum? And both could work, but let me just put that of how we should be looking at it, right? Most investors will not necessarily have the capital ready for them to deploy today, right? I mean, because we're on a monthly paycheck and we're kind of adding to our portfolio as we go along month on month, right? And with them, SIP becomes a very, very compelling choice to make that investment decision, because you're trying to avoid timing the market altogether. So, you've put that into autopilot for your portfolio, and the money's being, put into the funds that you've chosen over that period of time, and it continues on autopilot, which is great. I think the other powerful point of SIPs is what also does is it instills some level of financial discipline, right? Because we all love to spend, but what SIP forces you to do is be prudent with your expenditures, so that you've earmarked that amount of money from your monthly paycheck to ensure that you're kind of saving for the future, come what may, right? So then you'll peg your expenses according to that. So I think that's another very compelling choice for SIPs that comes about. Obviously, if you have the capital available to you on day one, or coming to you over a very short period of time, you would look to do not necessarily a lump sum, but a shorter term SIP, right? So, I mean, today, if I had all the money available to me that I needed to invest a large chunk of money, obviously markets being volatile, I have a long time period, no doubt, right? So I want to deploy my money, but I won't deploy it all in one go. I'll still do a staggered SIP maybe over the next 6 to 12 months. I might have a 10-15-year horizon, right? But I'm not going to deploy that money in SIPs, monthly SIPs, for the next 10 to 15 years, because that'll be counterproductive. Because while markets are not linear, they do kind of go up in a staggered fashion. So obviously, I would want to do a short-term SIP, which could be akin to a lump sum in a way, and that's how I would do it, right? But if you're doing something for a very short-term goal, which is, say, into a fixed income fund where volatility is really not a bother, right? SIPs become very, very useful, obviously, like I said, for financial discipline and volatile asset classes. But if I had only a 1-year investment horizon, I'll put all my money into the fixed income fund today. I wouldn't do that over a staggered 12-month, sort of SIP, right? Because I'll make the most of my investment over that time frame, knowing that there's limited to no volatility in the fund that I'd look to choose. I think putting all of these into context is how the investor should be making the decision. So it's purely based on the investor's investment preference, goal, and horizon. But obviously, like I said, SIPs is a very, very compelling choice for most of us, given that, you'll be investing for years and years, and, it's not that the money is available to you on day one.
And that's the consensus view as well, right? Suppose somebody bases their risk profile, their goal, has gone ahead and done the lump sum investing or SIP, whatever works for them. How often should they go ahead and need to assess the portfolio and reallocate? Do you think that also forms a big part of how you go ahead and build your portfolio?
Oh, absolutely. I think, that's a very important point and often gets forgotten about, that, you do all the math and the homework on day one. And then in a way, it kind of, think it's an autopilot mode, right? But that's not necessarily the case. The first thing is, we don't need to over-engineer this, right? But a couple of things that investors need to keep in mind is you have to, on an annual basis, review your portfolio, at least on an annual basis, or if there's a, if there's a lifestyle event or a change in your financial circumstances, maybe you got a large pay hike, or you've had a child that's born to you, or your goals have changed, then you need to reassess your portfolio in the interim. But otherwise, once a year is always a good choice to do that, because you've come with an asset allocation in mind, given all your goals that you had, and obviously when you think about it, you would want to reassess that. If the markets have run up and you're overexposed to equity, you would want to bring that down and bring it in line with your desired asset allocation. The other thing, which often doesn't get spoken about, is, even if you have a long runway to your goal, right, it'd be maybe 10, 15 years, you have to think about what we call, the glide path approach to investing. And I think that's very important, not just as we go along, but when you start your planning, because, you're going to put your return estimates according to the glide path approach to investing. And what is this glide path, right? Let's just take example, if you're in 2010 and you said, I had a 10-year horizon, I'm going to put all my money into equities. Sure, great, right? But come March 2020, we all know what happened to the equity markets, and if your portfolio was still 100% equities at that point of time, it might have gone up a significant amount over the last 10 years, but it would have corrected 30-40%. And you might have actually missed your goal purely because you were invested 100% into equities, very close to your goal date, right? So what do you need to do? The glide path basically is, means that you start reducing your volatile asset class exposure, which is largely equities, into the fixed income exposure as you come closer and closer to your goal, so that you de-risk your portfolio from a shortfall risk as you're approaching your goal date. And that needs to be baked into the calculations that you're doing. And obviously, like I said, you keep evaluating your portfolio on an annual basis. And if you have the glide path in mind, you will start reducing your or changing your asset allocation as need be, depending on the overall allocation as a demand. So I think those are a few things that investors need to keep in mind. We don't need to over-engineer it, but definitely, keep a pulse and understand really what your portfolio demands of the time that's left for it to invest in.
Oh, yes, absolutely. So does that mean, Kaustubh, you did mention it briefly as well, that higher returns are assured if there is a higher holding period? Is that something as a conclusion that we can draw, or it doesn't really matter?
So the probability is better, right? I think, again, just going back to a study which shows us that if you just look at, say, equities, right, as an asset class, the probability of making greater or more predictable returns goes up as you extend your time horizon. And, there have been studies done over, say, the Sensex or the Nifty over the last 20, 30 years, as you increase your holding period. So, in fact, if you had only a 1-year holding period and you did a rolling return analysis of the Nifty, say, over the last 30 years, on a 1-year basis, while the average number looks great, but almost, I think about half the times, or actually, I'm getting my numbers wrong, but maybe 1/3 of the times the return was negative, right? So 1 out of 3 times, had you come only with a 1-year investment horizon, your returns in the Nifty would have been negative. You extend that to 3 years, your average remains good, average of returns. The range of returns comes down. That means, which is more, the predictability is increased, but the probability of negative return also, and the number of negative periods was also reduced. As you extend that to 5, 7, 10 years, you would see that the probability of negative returns is almost zero, and the range of returns is much more predictable, right? So I think that's the beauty of, and that's why we say that, come with the right time horizon in a volatile asset class like equities, because we've seen time again that markets can have steep corrections, as we saw during COVID, or they can be flat for a prolonged period of time. But as long as you have a good time horizon, there'll be the sudden jump in the markets that will make up for all that lost time. But if you don't come in the right time horizon, it can be a result that you did not expect or want for your portfolio. So I think that's something that investors need to be very, very cognizant of when they're making this investing decision. So yeah, I mean, I think that's what history's taught us. And so if you come in the right time horizon, you just improve your chances of meeting your goals significantly.
Oh, yes. And there are some interesting studies that you've quoted. So we'll have a separate discussion for those because they sound something that investors can benefit from as well. Kaustubh, thank you so much for making sense of the basics because that's the most important thing to start from, right? So thanks a lot for joining us. Hoping to speak to you very soon as well.
Yeah, thank you, Sonal.
Okay, all right. With that, it's a wrap on this edition. But stay tuned for more news and updates and everything related to the mutual fund industry as well.